Welcome to the world of Forex trading, where currencies move in seconds, opportunities are global, and your ability to understand key concepts can make or break your success. Now, if you've ever wondered how traders manage to control massive positions, often in the tens or hundreds of thousands of dollars, without putting up that entire amount, the answer lies in one powerful word: margin. Margin is one of those topics that sounds complex at first, but once you understand how it works, it changes everything. It's not just a number or a requirement, it's the gateway that gives retail traders access to the same markets as institutions. But, and this is a big but, margin is also one of the most misunderstood and misused tools in trading. Use it wisely, and it works for you. Use it recklessly, and it turns against you faster than you can blink. In this video, we're going to break margin down into simple, practical terms. We'll cover what margin is, how it works in real trades, why it matters, and the risks you must understand. So whether you're a beginner trying to make sense of it, or an experienced trader needing a refresher, you're in the right place. Margin in Forex trading. In Forex trading, you don't need to put up the full capital to open a position. Instead, you deposit a smaller portion known as the margin, which acts as collateral to cover potential losses. For example, when buying USD/JPY, you don't need the full amount. The required margin is a percentage of the position's value, which varies by broker. How margin works. Margin is locked up during the trade and released once the position is closed. It's expressed as a percentage of the full position size, like 1% or 2%. For example, with a 2% margin requirement, you only need $2,000 to control a $100,000 position. Why margin matters. Margin allows you to trade larger positions with less capital. But remember, using leverage wisely is key to avoiding risks like margin calls. So now that you understand what margin is and how it functions, let's go a level deeper. Margin is closely linked to another concept called leverage. Think of leverage as a multiplier. It determines how much exposure you can gain based on the amount of margin you put up. For instance, if your broker offers 50-to-1 leverage, that means every $1 of your capital lets you control $50 in the market. But here's the catch. While leverage can amplify profits, it also magnifies losses. A small move against your position can quickly eat into your margin, and if your losses become too large, you'll get what's known as a margin call. Let's talk about that for a second. A margin call happens when your account equity, your balance plus unrealized profit loss, falls below the required margin level. At this point, your broker may either notify you to add more funds, or worse, automatically close out your trades to prevent further loss. To avoid this, traders monitor key metrics like free margin, the amount available to open new trades; used margin, the capital already tied up in open positions; margin level, a ratio that shows how healthy your account is. Staying on top of these numbers helps you avoid liquidation and stay in control. Here are a few pro tips for managing margin effectively. Never use all your available margin. Leave room for market fluctuations. Use stop-loss orders to automatically limit potential losses. Know your broker's margin call and stop-out levels. These vary between brokers. Avoid over-leveraging. Just because you can control a $100,000 trade doesn't mean you should. Also, during high-impact news events like interest rate decisions or non-farm payroll releases, volatility spikes, and your margin can be eaten up fast. Always reduce exposure or widen stop losses during such times if you're unsure. At the end of the day, margin is not something to fear. It's something to respect. It's the bridge that connects your capital to bigger opportunities in the Forex market. But with that power comes responsibility. The most successful traders aren't just focused on profits. They focus on capital preservation, discipline, and risk control. That's what keeps them in the game long enough to win. So whether you're trading mini lots or standard lots, always remember, margin is your tool, not your enemy. Learn how to use it smartly, and it becomes one of your biggest advantages.